Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, thank you, Andrew.
Good. Feels like another quite busy week. Um, let's dive right in and kind of recap the past week, market moving events, data, markets getting a bit spicier than they've been, and then maybe coming down today. Um, you know,
Okay,
government issues, strikes. Yeah, go for it.
just par for the course. So the big surprise, of course, was the Fed, even though it was completely in line with my expectations. Market got a bit spooked because the Fed is going to cut less than it said it would next year, and still planning to do a hike this year, in my view. None of this is going to break the above trend growth that we have or bring down inflation significantly, but nevertheless, it was a surprise, so people reacted. Um, in terms of the Fed this week, we're going to have a number of speakers. The most important will be Williams. Initially, well, or at least in July, he had this interview with the New York Times where he talked about his confidence that inflation would slow very fast next year, and that was based on his model. He also has a very dovish estimate of R-star. Against that, we had this week's FOMC, and Williams signed up on the dotted line. So presumably there's an object to all those policy plans, nor does he object to Chair Powell's view that R-star is a model, his model R-star estimates are model dependent and therefore to be taken with a pinch of salt. So I will be curious to see if he takes more of a moderate view on inflation than a couple of months ago. So that's for this week, for the Fed. Um, for the data, so this week there was a bit of a dip in economic surprises. The data was not as strong as people expected, but that said, it was not, the most important data this week. We have a lot of things coming up, and for once, I'm going to argue that data revisions are important. We're going to get a revision to the GDP data going back to 1979, so potentially quite strong revision. And I think we could see an upward revision in the recent GDP data, simply because it's been inconsistent with the employment data. So basically, we've had a decline in GDP per worker, which is very unusual in a recovery, and makes me think that we could very well, it could very well turn out that the GDP is stronger than was first estimated. So this is not going to change. If this happens, it's not going to change the Fed policy plans, but it's certainly, going to give more confidence to the hawks on the FOMC. Other than that, we'll have PCE. I'll be looking for the same broad-based acceleration of inflation that we saw in the CPI. Personal income and spending, I agree with the
Is
consensus.
there any nuance difference? Sorry, is there any nuance differences in how it's calculated between
Oh,
PC and like, because
you
obviously
know,
there's a lot of different factors, whether it's more manufacturing, more services, more rent and
so there is a whole table published by the BEA every quarter explaining the differences between CPI and PCE. So without going into the fine print,
right.
because PhD theses have been written on this topic, the residential real estate, the housing cost data is going to be roughly the same. The services data will be quite different, but I'm still thinking we could see an acceleration, and core goods are likely to be roughly similar. So that's the PC. Personal income and spending, I agree with the consensus that implies no change in the savings rate. That's my view too. Savings rate is very low. That's one of the reasons I'm so bullish on growth. We'll also get
Explain that again. Why you equate the savings rate being so low, and why you think that why you're bullish on growth? Because sometimes people are worried the opposite.
Because the US economy is 70% consumption. So if you can figure out what's going on with the consumer, you generally can figure out growth. And a key driver of consumer spending is the savings rate. It's personal income, so employment and wages mainly, and the savings rate. And so lower savings rates means that when firms hire more workers and pay them more, a greater share of that is recycled in the economy as demand for firms' products.
Okay.
So the University of Michigan final release for September, usually I don't pay attention to this estimate, but this month I will, because the initial estimates show a decline in inflation expectations that didn't make sense, given that survey-based expectation tends to be adaptive, i.e. reflect actual current data. And inflation has been accelerating, not moving down. So I'll be looking for a revision upwards of short-term and medium-term inflation expectations. Then we will have more residential real estate data, house prices. I agree with consensus that expects a further increase. New home sales, consensus expect a small decrease, but still that would place new home sales on an upward trend. And I agree with that. One of the difficulties the Fed is facing is that, paradoxically, higher interest rates are supporting higher residential investment. And that's because people are locked in their current home. So the supply of existing homes on the market is very limited. Actually, it's falling. And so the increase in supply has to come from new homes. And new homes, of course, mean new investment, while existing home is just a change of existing asset from one owner to the other. So new home sales are really doing very well by contrast with existing home sales. And the consensus forecast is consistent with that. And I agree with it. Jobless claims, I mean, noisy data, but I agree with the consensus, showing small claims, strong labor market. That's my view too. I mean, obviously, employment is slowing, but the balance between demand and supply is still very tight. So few people claiming for unemployment. The other thing that's likely to happen next week is that, contrary to my expectations, it looks like we're going to have a government shutdown. And I was expecting this to be business as usual. So the usual theatrics, each side claiming to be, defending the interest of the American people, and all the usual theatrics, and eventually in the night of the 30th of September, a last-minute agreement. And this time around, it's different. And it looks like two things are going on. First of all, the extreme conservative Republicans who, in June, when there was a debt ceiling agreement, were, I would say, outmaneuvered by their leadership and by the mainstream Republicans. This time around, they understand better how to use House procedures to make their point. And their point is they won't sign up a for funding unless there is a large decrease in expenditures. And to be honest, I was surprised in May, June, when we got a debt ceiling agreement without a much bigger decline in
Yeah,
expenditure.
we talked about that. Right.
And the reason was that the extreme right had been completely outmaneuvered by the speaker and the mainstream Republican. But this time around, they've learned their lesson. They are not going to support a continuing resolution. That's the first thing. The second thing is a week ago, House Speaker McCarthy announced the opening of impeachment proceedings against President Biden. And so as a result, Democratic House members have made it clear that they would not support a continuing resolution unless Speaker McCarthy gave up on the impeachment, which he cannot do without, risk of his losing his job, because one of the conditions for getting elected to the speakership was that he allowed the opening of a vote to remove him based on just one lawmaker, one Republican lawmaker proposal. So it looks like the crisis I was expecting around the debt ceiling is actually happening now. So the bottom line is we could well have a shutdown. Whether it will have an economic impact depends on how long it lasts. So we will get more details next week on the reasons for the shutdown. And so we'll have a better appreciation of how long it could last, probably by the end of the week.
Yeah. Okay. All right, cool. I mean, this was great, and congrats on the call. I was kind of saying on the Fed, you've been saying this for weeks that, one more hike and then 2 cuts for next year being priced out, which is basically exactly what happened. And just to reiterate, your call is still 3 actual hikes next year. Is that right?
Yeah, I think that inflation will remain sticky. And the one thing we saw in the FOMC this week is that the Fed reaction function is very consistent. Inflation is behaving per the Fed expectations, and so they're sticking to their plans for a hike this year. So next year, they expect inflation to slow, core PC to slow to 2.6% Q4 on Q4. And so if that doesn't happen, as I think it won't, they will have to do something about it. And my guess is that they could start hiking again middle of next year in a very gradual manner. And by the way, I don't expect this year's extra hike or even next year's 3 hikes to do much to growth or inflation.
Definitely not a consensus, but you have been right for 1.5 years now, so that's a pretty long time to be right. Okay, so
I try to follow the data.
Amazing.
Follow the data, not the consensus.
Right, amazing. Couple quick things for our certainly for our clients, especially our professional clients. We've added some new property data in better assessing what's happening through our China growth tracker. Ben, using kind of historical relationship between spotted and risk aversos, believes Eurostocky actually is, some people are calling for pullback. We actually think it's going to continue to move higher. Had a great breakdown from Henry on Bank of England. Also, very interesting one is Bilal looks at the relationship, threat of a possible global recession, China and AI, and how all 3 of those things can impact markets through some very interesting charts. Yeah, I mean, there's tons of great stuff. We reiterated, which the team, certainly Dominique, you and Mustafa and others continue to believe in higher interest rates in the U.S., especially in the long end. We've had this trade on for a while, U.S. versus Germany and Japan. And then Bilal has added to his bullish dollar versus euro in more of a basket trade versus Europe now. So long dollars versus euro, Swiss, and sterling. So please check out all those trades. And Mirza has added a few bullish dollar trades across EM, particularly in India and in Taiwan. And for me, that's it. I wish everyone a great upcoming week. And certainly for Jewish friends, a good fast over Yom Kippur, and wish everybody good luck. And parting words.
Good luck, and please send the feedback.
Awesome. Okay, cool. Thank you.